Dana, I know Lisa's really focused on a job-full economy, but I want to go to your call for restriction by the Fed after Jackson Hole. Are we going to calibrate for September 1 after Jackson Hole? Do we just need to get to Wyoming before we can look to the Fed meeting?
Well, Wyoming certainly is beautiful, but I think that the Fed is certainly data dependent. We're going to get several more readings on inflation, another jobs report, certainly updates on GDP, and I think the Fed is going to be looking at all of these indicators to determine whether or not it needs to go another 75 basis points or 50 basis points. But I think whatever it is, the Fed is going to continue to raise interest rates to really arrest inflation.
I mean, let's do the math here. If it's 175 beat move, or it's 250 beat moves, which is a stick, I get it. But what's a so what? Whether it's one move or two moves is a precursor to restriction. Does it matter?
Well, I think, just getting above 3% on the Fed funds rate, that's restriction. And, we can sit around and argue about it, but I think the fact
No, we don't do that on surveillance.
The fact that the Fed's been raising rates this aggressively, this quickly, it certainly is going to feel restrictive. We're already seeing that show up in the GDP data.
Dana, do you buy the data that we get on Friday? We heard Peter Scheer just earlier saying that the data doesn't seem to cohere with some of the granular, on-the-ground specific inputs. So do you think that it's going to get revised a lot lower and it's going to give a less rosy picture of the labor market?
Well, how much can you revise down? That was an astounding number. More than 500,000 jobs added in July. That would be a huge downward revision. And whatever the revisions are, they're probably going to be minor. What the labor market's telling us is that we still have a very strong labor market. Many people are seeing their wages rise. Many people are being hired, especially in those in-person services that struggle to find workers. It's really astounding what we're seeing. And I don't think that the numbers are lying to us.
So let's talk about what we heard from Peter Bukvar, which I thought was really fascinating that Tom brought up, that people are overhiring and companies are scarred by what happened post-pandemic when they fired a lot of people and then had to bring on staff that just was not there. How much is that going to be a persistent theme throughout whatever happens in this next cycle?
We think that labor shortages are here to stay. A lot of it's demographic. You have more people retiring from the labor market than you do young people available to refill those jobs. We also have very strict immigration policies in the U.S. That makes it very difficult to find labor from outside of the country. And still you have many people who are challenged with childcare issues. Many people don't want to work 2 and 3 jobs. That's why they're trying to find higher wage jobs. We think that this is just going to be an issue even beyond what we're thinking is going to be a brief recession in the U.S.
Okay, so what does that mean for how persistent upward pressure on wages is likely to be?
Well, certainly if inflation continues to be elevated and the Fed struggles to get back down to the 2% inflation target, we think that there's probably the potential for a wage price spiral. Already, if you match up the PCE deflator with the ECI, they're both moving together. And that's really a challenge that the Fed is trying to prevent from happening with its actions.
But obviously, its actions have a lagged effect. It takes a while for us to see the real impact of it, as evidenced by how strong the payrolls report was on Friday. So can the Fed act quickly enough that they are actually going to be able to lasso that and get that under control? Or are we going to be looking at a situation where this actually does end up eventually out of the Federal Reserve's hands?
Well, I think the Fed is acting as quickly as it can. I mean, other than raising rates every month, certainly at every meeting since March, they've raised interest rates, and I think the Fed's doing what it can. But as you said, monetary policy comes with a lagged effect. First, you're going to see the effects on things like mortgage rates and the housing market, and then consumer spending, and then inflation. And so it's going to take some time, but we feel that the Fed can probably do its job and get things done in terms of bringing down inflation.
Dana, does any measurement of housing rent or ownership get in the way of their plan? I mean, can housing be such a crisis, so expensive, so persistent, that it just gets in the way of their best outcomes?
Well, surely housing is a huge driver of inflation right now for consumers in the U.S. And certainly, as long as home prices, the valuations of new and existing homes continue to rise, that's going to show up in the OER and in rents with a lag, of course. And so that really does present a challenge for the Fed.